Hi class, I hope everyone's having a great semester. For today's lesson I'd like to go over accounting for merchandise and operations. The first one represents components for Wegland Company's income statement. It was to determine the missing amounts. First, when we start off with sales of 75,000, we're looking for our cost of goods sold, and our gross profit is 30,000. So to get cost of goods sold, that'll be the difference. If you take 75,000 minus the 30,000, that'll be 45,000. Now we're on the next one. To get operating expenses, we want to do a similar thing. To get a gross profit of 30,000 minus our net income of 10,800, that would mean our operating expenses is 19,200. Continue on now. Next one, looking for our gross profit. Gross profit always is determined by sales minus cost of goods sold. So for this example, we want to take the 108,000 minus 70,000. That'll leave you a gross profit of 38,000. And now to get our operating expenses, just like we did in A, take a gross profit of 38,000 minus net income of 29,500. Your operating expenses is 8,500. Now, for part C, it'd be a little bit different to get your sales. To get sales now, you want to add your gross profit and your cost of goods sold. So your sales would be 151,500. Okay. The last one, to get net income, take a gross profit minus your operating expenses. You take the 79,600 minus the 39,500. That'll leave you with 40,100. The next one. Number 2 says, at the year end, Garbo showed merchandise inventory of 98,000. Except you determined your actual inventory was 96,500. So you have to make an adjusting entry here. Okay, so to make an adjusting entry, you want to start off by debiting cost of goods sold. Okay, and you would debit it for the difference. If you take the 98,000 minus the 96,500, it would be $1,500. And the account would credit would be merchandise inventory for the same amount, 1,500. You would credit it because remember, inventory is an asset and decreases the credits. And we need to decrease our inventory because even though we had 98,000 in our books, in reality we had 96,500, the difference. Okay. Let's go on to the next one now. Number 3. Number 3 here says, on June 10th, Townsend Company purchased $8,000 from EP Company, FOB shipping point. Terms is 210 and 30, pays freight costs. Damaged goods returned, and so on. Okay. Well, the first entry we need to record is the inventory we purchased on June 10th. Okay. So it says here you purchased $8,000 worth of inventory. So we're going to debit inventory for $8,000 because, again, inventory is an asset account and increases with a debit. And then the account you want to credit, because we bought it on credit, would be accounts payable for the same amount, $8,000. All right, the next entry. The next entry says here you also paid freight costs on June 11th. Now, because FOB shipping point, we, the buyer, paid for the freight cost. And remember, class, when you look at inventory account, it includes all the costs you need to acquire the inventory and prepare for usage. And shipping is part of the cost to acquire the inventory. So again, you want to debit inventory for the amount you paid, which was $400. And now you actually paid for the inventory, so you want to credit cash for $400 because it's an asset and you want to decrease it with a credit. Okay. So now on to the next entry on June 12th. On June 12th says you return goods, damaged goods, for $300. The fair value of the goods is $70. Well, we don't take into account the fair value. I only want to see how much they were worth, which was $300. Okay. So now I want to start off by debiting accounts payable for $300. And the reason why I debit accounts payable is I want to decrease that accounts payable by that amount because I don't owe that amount to them anymore because I returned it. And then I want to credit inventory for $300 because that inventory is no longer in my warehouse and I need to decrease the inventory. All right, and then the last entry on June 19th. On June 19th now, you actually paid for the inventory. Okay. But don't forget though, we also had a discount of 2% because we paid within 10 days. The 210 and 30 means you receive a 2% discount if you pay within 10 days of the invoice date. If not, the net amount is due within 30 days. Well, we know we're going to start off by debiting accounts payable for the full amount that we owe, which is $7,700. Now we're going to credit cash for the amount we pay to cash, but we're not going to pay $7,700. Okay, let's do a little calculation over here. Okay, and we know we're going to credit cash, but let's see how much we're going to credit for. Okay, we owe $7,700. Okay, except, like I said, you received 2% off, so you multiply it by 0.98. Because instead of paying 100% of the cost, you got 2% off. So you actually paid $7,546, and that's the amount you will credit. Now the difference will go to inventory. Okay, we would put the difference to inventory of $154. You take the $7,700 minus $7,546. The difference goes to inventory because, again, we say we want an inventory to reflect the amount we actually paid for it. We don't take into account how much it's worth. Even though it's worth $7,700, you want it at $7,546 because that's how much you actually paid for it. The next part. The next part now says we want to record the entries for EPS. EPS now, they're the seller. So now we got to record it from a seller's point of view. Okay. Now, let's start the first one again on June 10th. On June 10th, they sold these goods to us on account for $8,000. Now, because they sold it, you're going to start out by debiting accounts receivable for $8,000. Okay, to increase that asset. Then you want to credit sales revenue by $8,000 because you want to increase revenue because, well, you just made a sale. Except remember, anytime a seller sells a good, they always got to make two entries. One for the sale. Now the next one, they got to record the cost. And it cost them $4,800. So anytime you have a cost to record, you guys want to start by debiting cost of goods sold for how much it cost, which in this case was $4,800. Remember, cost of goods sold would be an expense. You want to increase that. Then you want to credit inventory. Okay, to decrease your inventory because it's gone from your inventory for the $4,800. Let's go on to June 12th. June 12th was the return they made for $300. Okay. And remember, and the fair value, which was how much it cost EPS, was $70. Okay. Now, this one, because you bring the merchandise back into your warehouse, you got to make two entries again. Start the first one. You want to start by debiting sales, returns, and allowances, okay, for the $300. Because this represents how much, like it says, how much the goods were returned to you. Or if you granted an allowance, in this case was $300. And then you want to credit accounts receivable for $300 because now they owe you $300 less. All right. Now remember, these goods went right back in the warehouse. So to put them back in the warehouse, you want to debit inventory for the $70. And then you want to credit cost of goods sold for $70. You want to decrease that cost of goods sold because, well, it's not sold anymore. Okay. And then the last one, on June 19th, you receive payment. Okay. Well, just like we did earlier, just like I showed you up here, even though they owed you $7,700, they only paid you $7,546 because EPS gave them a discount. So you want to start out by debiting, in this case, cash for $7,546. That's how much cash you actually got. And that difference now is $154 that goes to sales discount for $154. Because you want to keep track how much discounts do you give out to all your customers. And then you would credit the $7,700 to accounts receivable, because now that account is all paid off. Okay. Hope everyone's having a great semester. If you have any questions or comments about this assignment or anything else, please feel free to contact me. Thank you, and take care.